All right. Well, this is going to take about an hour and 10 minutes. I think that was about how long it ran. Um, we are going to try and cover a lot of ground tonight. My goal is to really lay out the groundwork for how options work as a business, and then really discuss it at not a 30,000 foot level, but maybe a 1,000 foot level. Really, how to do some serious analysis of the overall market. Um, and I want to thank you all for coming. I'm recording. There will be a recording, and I will email it out to everybody later this evening. So with that, let's talk about what you're going to learn. Oh, that's me. Let's talk about me. That's me cracking it up with my girl Liz Clayman. She is hilarious, actually. I was a trader on the floor for a little under a decade. Since then, I have been I trade for myself, and then I am in the education and consulting business. So OptionPit does two things. We work with individuals to teach them, really how to trade like a professional. All right, we don't do any of the shortcuts. So with everything, we lay the groundwork. Why? If you lay the groundwork, then the hard stuff becomes much easier. It's always shocking. I have people that say, why do I need to know all this theory? Well, because if you know the theory, then actually when you get to the actual trading part, it's a lot easier and faster. It's actually spending the extra few hours really learning the theory actually will cause the rest of it to be much faster. Then the other piece of our business is in the consulting side, where we will work with funds that, hedge funds, money managers, institutional investors, to help them, one, implement option strategies, two, stress test option strategies, and we also do some outsourced risk management. So I like to joke, but this is true, we've worked with people that have $1,500 in their account all the way up to people that have $15 billion that they're managing. So that's what I think is really what separates us. So what you will learn, all right, in selling options, well, what about working with a foundation? I would gladly work with a foundation. I don't know that I've done that. I would gladly work with one, though. That's not true. Technically, I do work with with a foundation. All right, one. I do technically work with one. So in selling options, traders run their own insurance company. All right, and I'm going to spend a few minutes comparing insurance companies and options and just laying a foundational base for why you need to think about your business as an insurance company. All right. So what we're going to discuss is how insurance companies make money, how options and the insurance business are related. All right. How to, well, you're going to love options. All right. How to identify under and overpriced options, how to generate a position, selection routine, conditions of volatility that produce optimal conditions on a trade, and an example of a trade and how it fits a market condition. All right, so we got a lot to cover. I'm going through, 37 slides tonight. So you're supposed to, and I usually take about 2 minutes a slide. So the insurance business, all right, insurance companies make money selling insurance policies to many individuals. All right, the idea is that only a fraction will redeem it at any one time or at all. And our insurance underwriter will know this, right? Why is term life insurance so cheap? Term life insurance, I'm 36 years old. I can get like $1 million a year for like 20 some odd bucks a month. All right, why is it so cheap? Well, one, it's a finite time period, and two, nobody redeems. Yeah. Yeah, because it's age rated. Nobody redeems. Right. So this leaves, so the insurance have all this excess capital that they invest and manage. All right. So they've got the risk spread out over a large audience, and only a small portion are really collecting it at any one time. And then, to make matters easier, they even reduce their risk by buying insurance back in the reinsurance market. All right, we're going to talk about that part. All right, so I want you to think about how this works as a business. All right, so running a one-man shop, you know, I wrote a book with one of my first consulting gigs was a guy named Dennis Chen, who actually runs a hedge fund. So he and I wrote this together, and it's a business framework for trading equity index options. I will give one of these away tonight. All right. An autographed copy by me, from me. Ooh. Yeah. So options are like insurance. In fact, they are insurance. All right. Yeah, you're going to get a copy. You're going to get a copy of the webinar, not a copy of this book. All right. Somehow a couple of people got in their head that when I said everyone will receive a copy and it said register here, everyone will receive a copy, that they meant I meant the book, not the webinar. It's the webinar. So you're going to get a copy of the webinar. I can't afford. I think I have 1,200 people registered. If I bought everyone a book, I'd be out like 12 or 15,000 bucks, something like that. Sorry, that is not what that language meant. So back to insurance. All right, insurance policies, options. All right, policies collect dollars up front for obligations to pay a claim later. All right, selling options generate a credit up front for taking the obligation of buying or selling the underlying security at a set price in the future. So let's compare the two businesses. All right. So we start with underwriting and pricing. All right. That is your trade selection. That is your trade selection. All right. Then from there we have our reinsurance operations and claims processing. All right. That is the risk management portion. Then finally you have your customer acquisition, and that's your trade execution. Right? That's how they're all interrelated. Adapting option trading to insurance model doesn't take that much adjusting. It really is the same. Options are insurance, in my opinion. All right. So let's talk about what's involved in trade selection. That's market selection. All right. Are you involved in just equities? Or are you doing commodities? Are you doing gold? Are you doing, soft commodities? Are you going to deal in currency? What are you going to trade? All right. Pricing, finding the best price. Strategy selection. All right. Picking the right strategy for the situation. And then time frame. What expiration are you using? All right. Then comes the risk management. That's the position sizing. That's money management. So how much are you actually putting into the marketplace? Trade adjusting. Managing positions when they go for you and against you. All right. Buying options. That's the reinsurance. All right. Does anybody here think I just go out there and just sell a bunch of options? No. Anybody who follows us knows we are always looking to buy options as well as sell options. All right. We want to buy underpriced options. All right. Disciplined closing of positions. And then obviously portfolio diversification. All right. And buying options, closing positions, and portfolio diversification are the three that are really important. All right. And then trade execution is the route selection. How are you, where are you sending your trades? All right. Then strike selection. And then finally, complex and individual orders. All right. Are you, so today, I did a small, long iron butterfly. So I bought the straddle and sold the wings. And I initially tried to execute it as a complex order, all four at once, and I was trying to pay $3.99. All right. I then wasn't getting filled, and then legged it in 4 different pieces and paid $3.98, adding in the rebate I'm going to get on the exchange, posting the exchange trades. I'm a happy camper. All right. So now you get into the different functions. Why the rebate? One of the nice things about Interactive Brokers is that if you use their smart router, they share in the payment for order flow with you. So they will actually give you money back from the exchanges for routing your order. All right. So for instance, if you post a bid on the NASDAQ, all right, if you make a market on the NASDAQ, I believe they pay you 25 cents. All right. And then when you consider my commission is somewhat low, I get close often to trading for about free commission-wise. But you really have to know what you're doing, obviously. All right. So now, on top of the insurance company, you have your support functions. You know, every insurance adjuster or insurance salesperson or underwriter has back office support. All right. And that is your trading plan. All right. How are you managing and building your portfolio of trades? All right. That is, you know, and then your infrastructure. All right. Do you have backup if your internet drops? You know, what kind of computer are you using? All right. All right. And then finally, learning processes. All right. This is the part that I think most people skip. How many of you do a postmortem? I mean, lots of people do a postmortem on their losing trades. All right. The trades that don't make money. Very few people spend a lot of time looking at their trades that made them money. All right. That is the key. All right. Do you evaluate whether you did the right thing and whether you made the best trade even when you make money? All right. And if you're not doing that, you are missing out. All right. So do we all kind of understand how how options and how option trading is really running a business? Get it, you know, so we had someone say, yeah, getting out too soon, or maybe it wasn't even the best trade. Just because you made money doesn't mean it was the best trade. You know, it's like following a directions. Just because you got there doesn't mean you took the best route or the safest route. You know, like if I'm trying to go from my house to Chicago, I can take Roosevelt Road and drive through, you know, the west side of Chicago, or I can take the Eisenhower and buzz right in. What do you think is the safer route? Both will get me to my office. What's the safer route? Unless you get caught up in a pileup on the Eisenhower. Yeah, the Eisenhower, is terrible. So what I want you to start doing is think about, the point of all this is, if you want to become a premium seller and you want to sell options, all right, don't think of yourself as an income trader. Think of yourself as a businessman. You're in the insurance business. Your job is to create wealth for yourself selling premium. The reinsurance side is buying stuff, and that's not that hard. And I'm going to walk through a little bit of that. All right, so now what markets to trade? All right, so the first lesson we're going to talk about is how do you tell if an option is fairly priced? All right, so remember, our point is to try and sell overpriced options and buy underpriced options. All right, so then now you need to know, okay, what is our evaluation process? And that's where the model comes in. All right, insurance companies use You know, insurance companies use actuarial tables. Option traders use the option model, Black-Scholes, whatever. So you've got cost of carry, stock price, strike price, timed expiration, and forward volatility. All right, now let's talk about these inputs. All right, we all know what, you should know what the cost of carry is, right? What's, in our current interest rate environment, what is the cost of carry on you know, most equities? Zilch. Whole lot of nothing. All right. We know the strike price. All right. Yeah, dividend is included in the cost of carry. That is correct. So I didn't think about that. But yeah, in some stocks there is a dividend. All right. Strike price, we know what price we're selling, the stock price or index price or underlying price. Timed expiration, and then finally we have this forward volatility concept. All right. And this is what makes things different. All right. The nice thing about actuarial tables, all right, is that they're pretty precise. All right. That margin for error is practically nothing. All right. However, forward volatility is something that we don't know. All right. All right. So for a book, the first person to tell me what stock this is a volatility chart of will receive a book. What stock is this a volatility chart? All right, VL, you got it. Shoot me an email with your address, and I'll send you a copy of the book. The answer was Apple. All right, my email's mark@optionpit.com. We had a couple of GoPros, probably a higher volatility. SPX is a lower volatility. The volatility of VIX is about 100%. This volatility is around 20, 23. Good. All right. So now let's talk about finding the forward volatility. All right. We don't know the forward volatility. All right. And this is where analysis begins. All right. We don't know the forward volatility. All right. We have kind of two measures that we can look at that hopefully give us an idea. And I'm going to talk about those. So the blue line represents historical volatility, sometimes called realized volatility. All right. Realized volatility, in this case, this is 20-day historical volatility, is how much the market has moved over the last 20 days, the last 20 trading days. All right. Now, 20 trading days is essentially what? 1 month of trading. All right. Now, the red line is implied volatility. Implied volatility is how much the market is guessing the underlying is going to move over the next X period of time. So in this case, all right, this red line is 30-day implied volatility. So it's how much the market is guessing the underlying is going to move over the next 30 days on an annualized basis. All right, so right now on this chart, the market is guessing Apple is going to move for the next 30 days at a 24% volatility. All right, so these are the two things that we use. All right, so if you think about it, at the money implied volatility is kind of the market's best guess of where forward volatility is going to be between now and the next 30 days or expiration. But is it right? All right, let's take a look. All right, so this is 20 days, right? It's a 30-day HV. That should say HV. All right. So this is 20 days. So when, on February 16th, a month prior is about January 16th. All right. So on January 16th, the market was guessing that Apple was going to move for the next 30 days with about a 37% volatility. Was that correct? No. The market moved with an under 30% volatility. All right? So that means that volatility was 6% too high. All right? Do you know how much money the insurance companies would make if they could sell policies that were 6% too expensive? The boatload. Insurance companies make almost nothing on the actual insurance. They make a little. Where they make the money is on the float. All right. So now, we had a real problem here. All right. Implied volatility was too high. Guess what? All right. How often do you think implied volatility is correct? How often do you think implied volatility is overpriced? What is the insurance company float? So float is the ability to use funds that aren't yours. All right? So the fact that I've got claims that I'm going to pay out, but I pay out my claims slowly and I collect my cash more quickly. So in Connecticut, they don't need float. They need snowblowers. All right. So what we have here is a situation where the measure we're using to guess how much an underlying is going to move for the next 30 days is almost always too expensive. All right? On average, the S&P 500, so think about this, the S&P 500, are there any products that are really more liquid than the S&P 500? All right? No, there really isn't. And even that product, yeah, cash is more liquid. You're right, Tom. Even that product, the most liquid product in the world, on average, is between 2 and 4% overpriced. All right, so if the VIX today settled 15.5, in most cases, a huge majority of the time, all right, and over time, the S&P 500 is only going to move with a volatility of 11.5 to 13.5%. That is huge edge in selling options. All right? But does that mean you can just unilaterally sell options all the time? What do you guys think? Am I moving too fast, by the way? Or I'm trying to go as slow as I can? All right. Good. All right. Too slow. I'm getting good pace. Moving just right. No. Nope. All right. We got a couple of smart people saying too slow. But all right. I'm just making sure we're going at the right pace. I don't want to lose anybody. All right. And if you've got questions, I will definitely be on top. So, if we look at the couple of things to think about. All right. One, look at the realized volatility and implied volatility of the options. All right. Is there a trend? And then two, is the policy too expensive or too cheap? All right. If you can figure those out, all right. If I go back, if I were to look at this, look at what's been happening over this period of time, this is a 6-month period, what's kind of been happening to realized volatility in Apple? If you look at the light blue line, what's kind of been happening, would you say? I would say, without it being too dramatic, I think there's an increase in both over time in both implied volatility and in realized volatility, wouldn't you say? There is a small trend here. I mean, certainly this volatility is the highest we'd seen, relative to anything back in here. Look where volatility got pre-earnings in January. It got up to almost 45%. The previous one, it only got to about 33%. All right? So in doing this analysis, and I'm about to walk through how I analyze implied, historical, and historical volatility, implied volatility, and term structure. So we're going to cover 3 of the 5 major pieces I look at when I'm evaluating a trade. All right? All right. So now that we kind of understand what we're trying to do, right? Does everyone understand what we're trying to do? We're trying to find stuff that's too expensive and sell it. And we're trying to buy stuff that is less expensive and buy it as our reinsurance. You buy less of it. All right? All right, so what is the current realized volatility, the SPX? All right, how much is the market actually moving? All right, how much is that realized volatility? All right, and then finally, make sure. All right. Oh, this is a good question. All right, but it's only a month. All right, so what does 45 versus 33% mean as a whole? All right, so what 45% means is that for the next 30 days, the market is expecting Apple to move on an annualized basis of 45%. All right. That is what that means. All right. 33% means the market was only expecting 33%. So the fact that volatility got really high, way high, all right, meant that there was probably some opportunity for something to happen with Apple. And it doesn't mean that you couldn't sell something, all right, because you could. There was money to be made. All right, so now make sure you interpret HV, 45% of the underlying price. That's, oh, I get it. So volatility of price. So if I have, if volatility is how much an underlying is moving regardless of price. So 45% volatility on a $100 stock would mean over the next 12 months, we would expect with reasonable, about, 2/3 of the time, the underlying to move $45 or less on a $100 stock. Does that make sense? Up or down, either way. All right, so it's going to be either, 68% of the time, about most of the time it will be more on that $100 stock will close the year more than $55 and less than $145. And we've got almost 95% certainty it will close the year more than $30 or more than $10 and less than $190. All right? Yeah. Yeah. So now, and yeah, that volatility is skewed by an event, all right, which is something you have to take into consideration. All right. So now make sure you interpret the HV the right way. Look at the data set for large outliers. All right. Will the last 30 days be as volatile as the previous 30 days? All right. Is there something in there that's thrown things off? So here's S&P 500 HV. All right? And this is the first thing I'm looking at. All right? I love looking at how much something's actually been moving. All right? Now, the white line, I'm going to explain that right now. The white line represents, all right, the white line represents how much the underlying is moving in the past, has moved in the past 10 days. All right? So how much has the underlying moved over the past 10 days? The light blue line, so this guy, so that's the white one, so that's 10-day. The light blue is how much the underlying has moved over the last 20 days. And the question is this live vol? And the answer is yes, this is from live vol. All right? Then the gray line, this guy, represents how much the market has moved over the last 30 days. And then finally, you have this kind of purplish line, and that's how much the market has moved over the last 60 days. All right? So at the very end of the chart, over the last 10 days, the S&P 500 had moved at a volatility of about 7%, live vol. All right? It had moved at a volatility of about 7%. It's right here. All right? Over the last 20 days, it had moved with a volatility of, call it 16%. All right? Over the last 30 days, it had moved at about 15%. And over the last 60, it had moved at about, call it 13.5%. Please don't lie to me about the vol. Where do you get these curves from? This is from live vol. This is what I use. This is my trading platform. All right. Let me erase that. Erase these marks. Oop, that was not my intention. Erase all ink on slide. All right. So now, as I look at this, do I see any trends? Do I see any trends? And the answer is I see a very slight trend. I would say that over this time period, we had been coming into a period where the VIX and volatility was at its absolute lows. And we hit some incredibly low market movements. But over this period of time, I'm seeing a tiny move higher. And this is clearly not an exact thing. Yeah, so, somebody points out the 10-day is pretty low, whereas the 20 and 30 average around 15%. Well, what does that mean? That means the last 10 days, nothing had happened, right? But the previous 10 up in here, something dramatic happened. All right, so we're going to talk about that. All right. The 10-day HV is too short to evaluate actual volatility levels. Historical volatility is a 10-day look back at volatility. So the question is, are these curves moving averages? It is the volatility over the previous 10 days. Do we all know how to calculate something called GARCH? I'm not going to walk through that calculation. But it really is, it's a squaring function of adding up the day, every day and dividing over the number of days. So it's kind of a moving average. Think about it that way. But it's the previous 10 days of movement. All right? So you really can't evaluate volatility on a 10-day basis. It doesn't tell you a lot. But it can tell you if an event just happened, if something just happened in the stock. All right, that is the value. All right, so when I see this chart again, and I look and I see, let me erase that. So when I see a spread like this between 20 and 10, it tells me that there was an event that just happened. All right, and I love seeing this pattern. All right, when I see a pattern like this, you know what that usually, you know what VIX is usually doing? You know what where volatility is? You think volatility is overpriced or underpriced? Way over. Yeah, it's overpriced. Why? The market has a memory for things that just happened to it. We're going to talk about that some more, don't worry. All right, now 20-day. I love 20-day. This is the one I look at a lot. All right, that is 1 month of trading data. So 20-day, essentially 20-day HV. So here's the answer. Sell VIX options, buy SPX could be a strategy. Well, Sid, you know what trade I did today? I bought that iron butterfly, and yes, guess what I did against it? I bought puts in VXX. What do you think about that strategy? And it both worked today. I was pretty proud of myself. So 20-day is, I look at a lot. That is what tells me, yes, this is recorded. All right. 20 days really tells me what's happened. All right. What is the market actually doing now? That is what 20-day tells me. All right. What is volatility? What has volatility been the last month? All right. Where is, when I'm looking at my 30-day IV, what is that really, what does the last month look like to develop that 30-day IV? I love 20-day vol. I look at it a lot. 30-day HV. All right. It has less noise than 20, and it's good for traders who maybe trade a little more part-time. All right. All right, better? All right. All right. So, 30-day HV is okay. I like 60-day HV because it really gives me the long-term trend, what's been happening. All right, so if I pull up a chart, I don't think, is this from today? No. So let me pull up a chart of, that's not what I'm looking for. All right, well. And you should be seeing a blank screen because I want to show you. I'm going to show you what volatility looks like now in SPX. We're going to go to screen 2, and let's look at SPX real fast. You can see this is I look at this thing a lot. So let's look at the 60-day, just the 60-day HV. And what do you see? What kind of trend do you see in volatility? Yeah, there's been a serious trend of volatility moving higher. We had a real dip last summer. But we've seen a real serious trend up. And the fact that 60-day IV in the last couple of months, in December, hit highs we hadn't seen, that to me is telling. There you go. Now we got them all in the same spot. So yeah, there is some stuff there. All right. And now always look at the price chart to see if there's something that is not coming through in HV, in that historical volatility. All right. Why? Well, one thing that historical volatility that like Thinkorswim, I'm using Thinkorswim and LiveVol and Options Express. I don't care what historical volatility you're looking at. All right. They all generally use GARCH. All right. Now the problem is GARCH only compares end of day moves. All right. How often do you see the market open up 20 bucks and then settle unchanged, or up 10, down 15, and then settle up 5, especially in a volatile market? Well, that doesn't really show up. So that is why you have to look at the price chart too. All right. And I actually use a product called LiveVol X. All right. And that means, so I've got an integrated in analytics and execution on my station. All right, now, realized volatility. Falling versus rising realized volatility is going to be the #1 determiner of how strangles and condors and credit spread perform. All right? All of these, all right, in a rising, all of these sales, all right, you see right here, falling versus rising realized volatility, volatility, actual market movement, is going to really determine whether your short strangles, short condors, and short credit spreads work. All right? So if you are a credit spread seller, if you are a condor trader, if you are a strangle seller, the #1 thing you need to make sure you're good at is forecasting actual market movement. All right. Secondarily, is forecasting implied vol. All right. So basically, if you're going to sell it on a condor, the first thing you need to think is not is implied volatility too expensive. It's is market movement going to fall or stay the same? Then look at implied volatility and say, is that too expensive? Does that make sense to everybody? First, what are my expectations for the actual market movement? Then look at implied vol. Kind of cool, right? All right, so you've got to have your brain ordering how it does its analytics. Realized high vol means too expensive. Yeah, it probably is too expensive. If you think volatility could stay where it is or go higher, you probably don't want to be selling strangles or condors or selling a bunch of credit spreads. You probably should be buying straddles. All right, so now let's talk about implied volatility and how that can move things. All right, so implied volatility is how much the market is expecting how much the market is expecting the SPX to move over a period of time. All right. Now, over the long haul, implied volatility mean reverts. But can you always do a condor? No. There's no trade you can always do. Anybody who says you could do the same trade every month and over time make money is full of it. Indeed, David. Indeed. So these people are like, oh, same trade every month, blah, blah, blah. Clearly not trading. All right. Yeah. There are very few trades out there that are that systematic. All right. Closest thing to kind of month in, month out trading that you could do somewhat consistency would be volatility arbitrage. All right. What do you do for weeklies? I mean, weeklies are even more important looking at realized volatility, market movement, than the monthlies. Those are all gamma. All gamma. All right. Does realized vol revert as well? Yes. There is some reversion. All right, so now let's talk about it. But a lot of people don't really recognize how volatility mean reverts. All right? So there are about 4 main cycles for something like VIX. All right? There is really low volatility. There is low volatility. There's average to elevated volatility. And then there's high volatility. All right? Now, do you think that that looks like a bell curve, how volatility is shaped in the S&P 500? You know, those periods. All right? Is volatility low and average high, you know, a lot more than it is really low and really high? No, there is no bell curve on the screen. I'm just discussing it. All right? All right? So my question is, do we think there's as much really low volatility as there is really high volatility is really my question. What do you think? Yes or no? There are as many days where the market volatility is really low as there are days where market volatility is really high. The answer is no. There are way, way, way more low days. Low and really low volatility probably accounts for about 70% of the market vol, market days. All right? Then you get high and elevated, kind of like we've had over the last couple of months, 20-25% of the time, and then high volatility maybe 5 or 10% of the time. Low is going to be a VIX between 10 and 14. All right? And you know, or really low is going to be between 10 and like 13, 10 and 14. Low is going to be between 14 and 18. All right, 18, and then somewhat high to average is going to be 18 to about 23, and then anywhere above 23 is high vol. All right. Now, the reason why is there is a lower bound to implied volatility and realized volatility. No matter how much the market stops moving, it's not going to move less than 5 or 6%. And if volatility is always 2 to 4% more expensive, then the VIX is really kind of has a lower bound of about 10. You guys know how many days has the VIX printed below 10? Do you guys know that number? It's more than 2. I believe the number is it 14? I wanted to say it was 12. Yeah, it's about 11 or 12. All right. So now, at the same time, so it's really got a lower bound, and at the same time, it can go as high as it wants. You know, in '08, the VIX got up to 80. You know how many days of 10 vol you need to get that 80 average down to that 20 mean that everybody talks about? A lot. All right? So really, I want you to think of normal volatility to be about 17.5%. That is going to be your line between low and high vol in the S&P 500. A little tangent there, but I think it's an interesting topic to discuss. All right. So implied volatility is so volatility does mean revert. All right. So then I use the exact durations to look at what's going on. I look at 30-day IV to see what might happen soon, how the market is pricing the immediate, and I look at 90-day IV to look at long-term IV trends. IV and fair value. All right. Implied volatility. This is the market price of volatility that buyers and sellers of options are trading that bring the volume to equilibrium. All right. That is fair value. All right. The trick is that fair value changes as IV expectations change. And fair value is sometimes not fair, essentially. So if you look at a chart, all right, of volatility, you can see the green is implied volatility, the 90-day implied volatility. The red is 30-day implied volatility. All right, and you can see 90-day moves a lot less and shows a real trend. And buy low IV 40 days out and wait. Yeah, I mean, there is something to be said on that. You know, diagonals, things like that. We're going to talk about that. So the one thing I'll tell you, so on these peaks, would you guys be wanting to buy volatility or sell volatility? You know, you'd think that. You would think that, but you're wrong. You're wrong. Now, if you can guess the market direction, you're right. But here's the issue. And let's just think about the last couple of days, all right, or the last couple of months. Has the market been more volatile on rallies, or has the market been more volatile on sell-offs? It's been way more volatile. It's been way more volatile on rallies. Rallies have been about twice as fast as sell-offs. So I'm not saying you couldn't sell volatility on some of these peaks. You can. But you can't do some of your plain vanilla trades. All right? You can't do some of your plain vanilla trades. Yep. Things like ratio spreads have worked really well. All right? So believe it or not, and here's another tip. I'm going to give you one. If this is the only thing you take out of this, it was worth your time. All right? You know, Russell Rhodes of the SIBO and I, doesn't vol usually go up when market goes down? Yeah, implied volatility has been going up when the market goes down, but market volatility has been higher on rallies, if that makes sense. So Russell and I spent some time. We've been doing these studies with about 26 years of SPX data. And the one thing I can tell you Isn't selling volatility the same? Isn't selling volatility the same as selling premium, e.g. put spreads? Yeah, yeah, all right. And, you know, on some of these peaks, they do show that, you know, you get the turnout. The put spread might work. Yeah. So it's all buying program. Yeah, there's all sorts of stuff involved. So over 26 years, all right, do we know what the symbol for 30-day volatility is in the S&P 500 that the SIBO publishes? Yeah, there's huge gamma risk in selling the peaks. That's why. All right? VIX. Now, does anybody know the symbol for 90-day volatility on the S&P? I believe it's actually 92 days. VXV. All right, now, you're correct. You're all correct. VXV. Now, there is a couple of clowns out there saying that if you go long the market when VIX crosses VXV, it's a great going long symbol. All right? Who's heard that? It's a load of baloney. It is so wrong historically. It's stunning. It is stunning. All right? The problem is, as a percentage of the time, going long the market when they cross works. All right? However, the losses that you sustain when the indicator doesn't work far exceed what what you make on when they win. Does that make sense? So if I win 75% of the time and I win $1, all right, 75% of the time, but when I lose that 25% of the time, I lose $10. Does that have a positive expectancy? No, and that is how that spread works. Now, I'm going to tell you how to actually use it. Right. So when you see VIX cross over VXV, all right, and then it crosses back below. All right, so VIX goes over VXV, and then VIX crosses back below VXV. Going long when that happens has a massive positive expectancy and crushes the S&P 500. All right, so if all you did, yeah, so when VIX is back into contango, if all you did was hold SPY when VIX is lower than VXV, go to cash when VIX gets above VXV, and then buy it back when VIX goes back below VXV, you would destroy the S&P 500. For Breaking Bad. Any questions on that VIX VXV tangent I just went on? All right. Can I repeat that? Yeah, good tangent. All right. If you're just as a basic buy sell program, very basic buy sell program, if you go to cash when VIX crosses above VXV, all right, and then go to, it doesn't happen that often, and then go back into the market when VIX crosses back below VXV, you will outperform the S&P 500 astoundingly. I mean, I believe, looking back at, 2011, you avoid, I want to say you avoid something like 400 points of loss in the S&P 500. and going back to 2008, I believe you miss. I believe you get back in at around 1,000, and so you or around maybe 900. I want to say. All right, so you miss the run up. You miss between 680 whatever and 8 or 900. Right. All right. Yeah, well, the good news is though, you get out at like 1,200. Would I be able to email you that study? We're actually it's not published yet. Why does that work? Because that shows you the times where the market is illogical. You don't invest in an illogical market. Now, obviously, past performance is not indicative of future returns. This is all for educational purposes. You know the drill. All right? You don't try and, it's like when the VIX is above VXV, it's like trying to rationalize, going long the market for value is kind of like trying to rationalize with a 4-year-old why it's their bedtime. He's 5 now. How is your 4-year-old? He's 5 now. All right. So, little tangent, but I like to drop these little nuggets. We've dropped a couple little nuggets in here, haven't we? I like to drop Easter eggs of knowledge in my presentations. So, implied volatility, whether premiums are actually really, really cheap, all right, is going to determine whether straddles or butterflies and debit spreads are profitable. All right? So the purchase price is derived from that IV. So if you're going to buy a straddle or you're going to buy or sell an iron butterfly or you're going to trade debit spreads, that is really where IV, then you look at realized volatility. All right? So we've got now 2 different ideas. Do I conduct mentoring? I do. All right. So buying straddles, or buying or selling butterflies, or if you're going to go long call spreads, things like, or put spreads. All right. That is first you look at implied volatility. What's your implied volatility expectation? Then you look at what's your realized volatility expectation. All right. So that's the order for making the trade. All right, so condors, strangles, credit spreads. Market movement, then implied vol. All right, then straddles, butterflies, debit spreads. Implied volatility, then market movement. You look at both, obviously, always. But you've got to have to hone in on one. All right, now, using the last thing I'm going to cover is term structure before I get into, before I go through a few things. So we're going to talk term structure. There's other things I look at. Skew, sometimes called kurtosis. All right, and then obviously overall position. What my position is. All right. So using IV, look at the term structure. All right, 30-day IV is below or above 90-day IV. 30-day IV or lower, or in contango, denotes a calm or logical market. It should be considered tradable in a standard fashion. All right, the market is likely. Your assumptions, when the VIX is lower than VXV, your assumptions are more likely to be correct. Comes down to that. All right, if the market is in a backwardation where 30-day IV is higher than 90-day IV, market is less than logical. All right, it's going to be more reactionary, less likely to hold any trend, and assumptions are less likely to work. You have to be much more quick on your feet. Don't have something cool like LiveVol X or LiveVol Core or LiveVol Pro. You can use VIX versus VXV like we talked about earlier. You know, the SIBO puts out all sorts of volatility indexes out there. Pretty neat. All right, within contango backwardation periods, there may be times where options seem under overpriced in 1 month versus another. This is where time spreads come into play. Look at current mean relationships. If VIX has been trading at 1 point under VXV for the last 3 months, and suddenly it dips to 2 points below VXV, something has changed. In normal periods, supply and demand create these trades. In normal periods, supply and demand will create interesting trades. All right, Carol, I will send you out the rest of the trade. All you're going to miss is that we're going to walk through how I come to a trade decision. All right. Yeah, VXST is the weekly vol. All right, and that one really is hard to use, I think. It's interesting. You know, I like to call that the panic index. All right, so now term structures. Traders looking to sell or buy premium can really move around volatility. Term structure is going to be how VIX, how the front month and the back month are priced against each other is going to be the #1 determiner of how calendars, time spreads, diagonals, and double diagonals perform. All right, so if you know, term structure is important for, you know, the month you pick. What is a time spread? You know, a time spread is just another word for a calendar, or like maybe a reverse calendar, a short calendar. You might call it time spread. But we never, when I was on the floor, we never called them calendars. We always called them time spreads. All right. And now I'm not covering stuff like front spreading and back spreads and you know, broken wing flies, some other things. But term structure is really, you know, how is one contract priced against another in the exact same product? That is where term structure comes into play. That is where you figure out whether to buy or sell calendars. So now let's walk through a trade. This was, we're going to walk through developing a trade in Facebook. All right, so Facebook, I have a consolidating chart that I think is trending higher. Am I telling tales outside of school here, guys? Anybody disagree? You know, I certainly see, you know, I'm going to say that volatility is falling in this name, all right, just by looking at the stock chart. All right. Well, then I look at, the HV chart, and if you think the stock itself is consolidating, what's happening to the realized volatility of Facebook? Holy bananas. So volatility is not just low, it is dropping and staying dropped. All right, it is moving itself lower. All right. All right, then finally, I look at implied vol. Now, 30-day implied volatility is low. All right, I don't think Facebook is going to 30 anytime soon. All right, implied volatility is low. All right, for sure. But realized volatility is sunk to 20%. And I can sell 25. Meanwhile, that spread, the spread between 30 and 90 is not that wide. All right? So, and 90-day volatility is extremely low, even relative to 30-day volatility. So now I'm going to go through my checklist. All right, what is the price action? Consolidating, probably bouncing, or meandering. HV is falling. IV is low. Term structure is in a tight contango. So I have low IV, falling HV, and a tight contango. All right? So we've got all these different pieces. What do you guys think is the trade that I picked? And don't cheat if you saw yesterday's webinar. So someone said iron butterfly, and I liked, that was my second choice. You thinking like the 75, 77 and a half, 80 iron fly in March, something like that? Or the 75, 80, 80, 85 fly in March, something like that? Maybe the 72, 77, 82 and a half. How did I figure out the term structure? Well, you know, I can see that 90-day vol is about as low as it's ever going to get. And then I can see the vol spread here is pretty tight. Certainly not wide and deep like this, right? I mean, I think there's a chance vol could creep a little higher. But I'd rather own the long-term stuff than the near-term stuff, especially with volatility sinking. Calendar about the market, real close. The trade I ended up doing, all right, was a diagonal spread. All right, I want a trade that does well in low HV, so if nothing happens, has exposure to long IV, but is not going to get over-penalized by the term structure. All right, so I wanted to do a diagonal spread. So I've got long Vega, I've got short premium, and I've got less term structure risk. And so you can see here's the diagonal. All right, and you can see if Facebook drops 2%, but volatility goes up to, you know, just to a normal level like, you know, 28 or 29, you know? So volatility just goes from 24 to 29 on a 2% sell-off, entirely possible. I don't lose any money. I lose $1. And if it rallies or stays, I make money. So do I like trades where if it drops a little, I don't lose any? And if it sits or rallies, I make money. What do you think? Now, obviously, if it tanks, I'm going to lose money, right? What was the legs for the diagonal? This is the, I did the 72 and a half, 75, I did the ape, I believe it's the ape, oh, I don't remember what I did. I think I did the Feb, or the March, I did the March, April, 72 and a half, 75 spread. So I sold the March 75 put, and I bought the April 72 and a half. All right, so in summary, insurance companies make money selling premium. Option traders have to find premium. This one or this one? All right. All right, learn to read price, HV, IV, and term structure, and use the information the market is giving you to find the right trade. So I'm doing a course Saturday the 28th. Me and Andrew are going to teach it. It's going to be at minimum 3 hours, probably closer to 4. All right, and it's creating income using option spreads. All right, you go to optionpit.com/income. Normally, we would charge $247 for these Saturday classes. All right, today I would charge you $147, so that's $100 off. Now, because you just sat and listened to me talk for 80 minutes, I'm going to take an extra $25 off. When you sign up, use 25_off to take the $25 off. So it's $122. All right. So what you're going to understand, you're going to learn really about the volatility cycles. You're going to learn about how to integrate vol and stock charts on a real intuitive level. I'm going to dig into the nitty-gritty. All right. I'm going to kind of walk through how to figure out all of kind of the major trades. All right. All the strategies. Yes. All right. So what we just did with that diagonal, you should be able to kind of figure, my goal by the end of this class, you should be able to decipher the best time for a condor, a fly, calendar, diagonal, credit spread, debit spread. All right. It's going to be February 28th from 9:30 a.m. till we're done. All right. And it is going to be recorded. You'll get to keep the recordings and the slides. So we're going to teach you some risk management stuff. 9:30 Eastern time, 8:30 Central. So, any questions on the presentation, on the course? All right, we did have a long question here. When you say spreads, is that different than buying units? Yes. It's Saturday the 28th. All right. Hey, Mark, how often is risk not price appropriate in options? I would use the financial crisis as a good example. If you were to ask somebody back in '04, likelihood of a national housing market crash, yeah, I mean, the markets are terrible at evaluating risk. They really are. Can I write down the Facebook diagonal trade? Yeah, it was the March 75 versus the April 72.5 put spread. Do you think it's sustainable selling just premium with pattern day trading restrictions? No, I mean, I would typically buy premium as well. I mean, one thing we didn't cover is when to buy premium, when to buy VIX. Yeah, I can put a link to the chat. Yep. All right, how do you manage wide bid-ask spreads in SPX? Believe it or not, I know the SPX. The inside market on the SPX is about 30 cents, which is the equivalent of 3 cents in SPY. All right. So I'm always a proponent of, the way I really like to trade is I'm looking to, I'm actually going to be in New York at that. After I'm done presenting, I'm going to be, I'm going to be probably presenting at the Traders Expo. George, we are going to record this, so you can come back and watch it later. So that's going to be the fun part. How do I explain to my wife that $147 will be debited to her account? Yeah, you can email me questions after the fact. We always answer. Tim, I think your wife will understand when you don't lose $147 on your next trade. And it's only $122 because I gave you the coupon code. Is that $25 off the $147 price, leaving the net $122? That is correct. Use code 25_off. And honestly, if my wife spent $122, I wouldn't even look twice. And she wouldn't look twice at me spending 122 hours on something. I'm just $122 on something. Now, if it was $1,200, well, if you can't, I'll rebate it back. If for some reason the promo code doesn't work, I'll rebate back the $25. I promise. Now, if I walked in having spent $1,222, my wife would have a conniption. Will I be teaching adjustments? Yeah, that's part of the risk management. We're going to talk about adjusting and different things like that. You guys are a hard audience. I've got a lot of stuff. You're going to learn. Ask people that have taken our Saturday classes. They're always worth the money. I always buy my wife something more expensive than I buy for myself. Me too. When will we get a copy of your slides? Shoot me an email. I'll send them out. And I should have this posted. I'll send an email out with the recording tomorrow. And also, this was only my second time doing this presentation. So if you've got some feedback that isn't mean, I would love to hear it. All right, so if the promo code's not working, I will rebate back everybody that buys tonight $25. I promise you. And tomorrow, whatever. Yeah, you know, what was funny was for Valentine's Day, on February 13th, I managed to do something kind of stupid that my wife wasn't exactly pleased with, and my Valentine's Day present, the cost of my Valentine's Day present exponentially increased. Can you use interactive brokers or TOS for your type of volatility analysis, or do we need to subscribe to live vol or even option view? You can absolutely use anything. Now, one thing if you use interactive brokers, live vol runs over IB, and my clients have a really good, we get a preferred rate for my clients at live vol X. And actually, if you don't want to put a large amount of money in live vol X, I can get you live vol core somewhere else. That will, and I can get you some free trades over there as well. So I really work my clients. When you are one of my clients, I go to bat for you. Just know if you want someone to negotiate commissions, it starts at 60 cents. I've got guys that pay as low as 15, I believe. Or no, 25, excuse me. I'm not telling you what rate I get, but I can tell you it's not 60. Yeah, live vol X actually runs over interactive brokers. Yeah, I don't get 15 cents either. Yeah, just shoot them an email. They should be able to. They might be willing. If you want live vol X, the nice thing is you get live vol X for free if you have a live vol account. Live vol X is awesome. I love it. You can't trade futures on live vol X. They do have a way of doing it, but you have to basically migrate. You have to toggle between the. It's great for options. It's not great for options on futures, but it's great for options on index. On indexes. I mean, the nice thing is they actually give you accurate vols for SPX, something you can't get out of any of the other trades. Yeah, thank you for, I want to thank everybody for coming. I think I like to, I really, when does this offer expire? The event is on the 28th. Get yourself signed up. Do me a favor and get yourself signed up by the 26th. For the $25. Like I said, if the code's not working, just email me. I will rebate you the dollars. I promise. You've got me on recording. All right? All right. Thank you, everybody. I want to thank everybody for coming. And yeah, I'll probably be. I've got a meeting with the Volatility Exchange guys, so I'll probably be around there somewhere. Not planning on doing anything crazy though. I don't know if I'm going to speak or not. All right, guys. Everybody have a great night, and I will talk to you soon.